Hello guys, this is Ali. Welcome back to another trading video. In this particular video, I'm going to be talking about one of the important tools of the future available to footprint trader, which is called Imbalance. It is the important tool in terms of understanding the market dynamic, whether the buyers or the seller are in control, and understanding the support and resistance levels. So without further ado, let's get to it and learn it. Before we begin, I have to define what the imbalance is. If you're coming from the ICT or smart money, you already know what the imbalance is. But for those of you who don't know it, I'm going to explain it first. Well, imbalance happens whenever the market goes up or down aggressively. Okay, what happens behind the scene is that when you are clicking on a buy button, you are buying from a sell limit order. Basically, some people have put sell limit orders at some levels, and when you are clicking on a buy, you are buying from those sell limit orders. And when you're clicking on the sell button, what happens is that you are selling to the buy limit orders. Okay, so buy limit and the sell limit are our liquidities, and when you are buying or selling, okay, that's what happens behind the scene. Well, when too many people, for example, click on a buy button, what happens is that lots of sell limit orders get executed, okay, because people are buying aggressively, they are lifting the offers, so only the sell limit orders get the time to execute, okay. And those people who want to sell aggressively, they don't get a chance to sell aggressively because the price is moving up, okay, too fast, and some buy limit orders remain in place, okay. They don't get executed because the sellers don't get a chance to sell. Buyers are aggressively buying, okay, from the sell limit. That's what happens. So now that we know what the imbalance is, let's see it on the footprint chart, okay. This is a footprint chart of the gold 5 minute, and you can see some numbers here are green and some number are oranges. Of course, you can change the coloring to your favorite. I've chosen green for buy imbalance and orange for sell imbalance. Okay. Now, how this number works? Okay, why this 14 is green and not the 17? Here is how. You as a trader choose a ratio, okay, to be specified as an imbalance and is not a constant. It changes based on the underlying instrument, whether you're trading gold, Nasdaq, mini, whatever, or the underlying time frame, or if you're using a range chart. So it depends on what you are trading or what you are looking and the time frame. So let me show you what I've chosen for the gold here. Here's the setting of my footprint chart, and for the imbalance I've chosen 150%. So it means whenever the other number, it is 150% bigger than the other number, it will be printed as an imbalance. But bear in mind, you have to compare the two numbers diagonally, which means you compare the 14 with 3, 17 with 28, 35 with 12, 17 with the number below the 12, which is not printed, and that's it. So 14, it is 150% bigger than 3, that's why it is green. 35, it is 150% bigger than 12, and that's why it is green and it's a buying imbalance. Now the selling imbalance happens. Take a look at this one. 16, it is 150% bigger than 4, okay, and it is printed as a selling imbalance, okay. Here we have multiple buying imbalances at the top of the candle, okay, and a multiple buying imbalances as well here. Now that we know what the imbalance is, there's another thing which is called a stacked imbalance. Whenever you have multiple imbalances lying on top of each other, you call it a stack. And the number of the imbalances is determined by the trader itself. I've chosen 2, which means if I have 2 imbalances next to each other, it will be considered as a stacked imbalance. And my software extends that area to the right as a mechanism for a support and resistance levels. Okay. Now, let's see the stacked imbalance in action. You can see pretty much the market was bullish, right? And when it reached this top, what happened? We have multiple buying and stacked imbalances at the top of a candle. I explained a minute ago that buying imbalance, okay, means that there are too many buyers aggressively buying. So why the hell the price failed to close at the top of the candle despite having too much buying imbalance? So there's something going on with this movement. We have too many sellers. The aggressive buyers cannot compete with the selling going on inside the market now. And you can see in the next 3 to 4 candle, market dropped, right? So whenever you see something like this happening, okay, you want to basically bail out. So if you were in a trade somewhere around here, you went long, let's say you went long here, when you see something like this happening, you want to exit your trade or save some profits or risk free your positioning. So this is stacked imbalance. This type of stacked imbalance tells you what's going on with the market. So let's see another use case. Here, the stacked imbalance is at the middle of a candle. Candle closes bullish, almost at the high, right? So next candle, the market tries to go down. What happens? It can't go down. Why? Because of this stacked imbalance. Okay, that's the first thing here. It is combined with the POC, also with the VWAP line. So we have 3 levels not letting the price to go down. Eventually market moves up. Also on this candle, I have a stacked imbalance here. You can see the market is trying to go down, but the stacked imbalance is not letting it through. Okay, so you could buy here and then sell at the top. Another example here, there's a stacked imbalance, right? The market is trying to go down, but it can get through this stacked imbalance and boom, voila, it goes up aggressively. Here is a selling stacked imbalance. You can, this belongs to the past. Let me zoom out just to see about it. There you go. I had a stacked imbalance in here, and when the market reached up here, you can see market was not able to go higher. It retraced a little bit, pulled back from the resistance, and then continued going up. Okay, so that's one use case as a support and resistance levels, and the second use case in terms of understanding the reversals. Okay, whether the market wants to bounce back from a level or continue with its current direction. It is really, really helpful. There's another stacked imbalance here. Let's take a look at this one. You see, the market was going up and pulled back, boom. It hit the stacked imbalance region and then moved back up. So the role of a support was well played here, right? Okay, let me show you another example here. So in this particular case, did not really work great because when we have this stacked imbalance, the market did not move aggressively to the upside, and there was something wrong with this one. Take a look at this here. Again, we have the stacked imbalance at the top of a candle, and yet the candle failed to close at the top. Okay, so it closed below the middle even. So it is not a strong bullish case, and that's why this level gets breached eventually. Next example, we have a stacked imbalance here. Let's see if it was respected by the market. You have to zoom out a little bit. So the market did not really reach that level. Okay, so let's keep that. Okay, there you go. Take a look at this stacked imbalance here. You see how perfect is this? So this is the Friday movement. Okay, actually gold went down from the peak all the way to this stacked imbalance here. You see there how the reaction was phenomenal. It was a perfect reaction, flawless. And the market moved back up toward the VWAP line and eventually broke to the VWAP. Let me show you another example here. There you go. Market moved up. It hit the VWAP line. Okay, VWAP did not let the market to go up. What happened? Market moved down. So it came to the level of a stacked imbalance, buying a stacked imbalance, and voila, market moved back up, right? Tomorrow, when the market opens up on Monday, we have a level here. I'm gonna mark it. There you go. So we will wait for the market to come up here and see the reaction to this stacked imbalance. But one thing you have to note that market has already reacted to this stacked imbalance here and has moved on aggressively. So this would be the second reaction to this stacked imbalance in case it goes up there. Okay, take a look at another example here. Market moved down and while going down created a stacked imbalance level. There you go. Market moved up, hit the level of the stacked imbalance, and take a look at here. I've talked about the reversal candle, okay, POC at the top of a candle, and yet the candle closes bearish. And what happens? The market, boom, goes on aggressively. So stacked imbalance is quite important topic, guys. Remember that. Make sure you remember that. Here, even in this particular instance, we have a stacked imbalance. Market reached a high. It couldn't get higher. And look what happened. It moved down, hit this stacked imbalance, okay, moved back up. Again, reaction. Ultimately, the market broke through the stacked imbalance area. So guys, that's it for this video. I've shown you most important use cases for the stacked imbalance, but make sure you combine what you've learned in this video with the things that I taught you in the previous ones, like the cumulative delta divergence and reversal candles. Everything combined is going to be a complete package for you guys. Make sure you stay tuned for more videos. Thanks for watching. Goodbye.